Mavericks. How's it going? This is Rob Reinhold. I'm joined by Darren Fisher, and this is the Trading Room from Maverick Trading. Here we are going into monthly options expiration week. October 21st is when the monthly options will expire. This week, we just had some crazy action. And I don't want to I could spend probably 20, 30 minutes going over last week, but we really want to talk about next week. So let's do a quick recap here. We got wild swings in the market. So we had 4 out of 5 down days. And the Dow actually ended the week up, if you can believe it, even though 4 out of the 5 days were down. The S&P ended down a little bit. We'll cover all those numbers. But Thursday was the day. And we had talked about the market was likely going to fall the first 3 days of the week. And we thought we were going to be at the lows right when the CPI report came out. And that call was great because that's literally exactly what happened. Monday, Tuesday, Wednesday, we dropped. Thursday, we fell. We gapped down 3% off of a really hot CPI number. And you can see here, these numbers are hot across the board. Month over month was up. Year over year was up. The core was up. Everything was much more than expected. On Wednesday, we kind of got a preview with the PPI being more than expected as well. So that right there just caused huge volatility. And again, we saw a 6% move off the bottom. So the market gaps down 3%, and it was very pessimistic. And then we rallied, and the rally picked up steam. We had lots of short covering in there. And really what happened was we had 2 things peak. We had the bonds peaked. So we had the 2 and the 10 year. They started to come down on Thursday morning. And we also had the US dollar peaked and came down. So all of that together caused this enormous bounce. And I did the video on Thursday after the market closed. And I talked to our traders. I said, hey, look, that could be a bottom. That could be a capitulation bottom where then we get a couple weeks to the upside. We had a high enough VIX. We had enough pessimism. But I said, I need to see the next candle on Friday. If the next candle on Friday is a green candle, that was likely a tradable bottom and a bounce that we could probably jump on. I also said if it gave back half or more of the rally, then that's probably just a one-day thing. And that's literally what happened. So Friday morning, we gapped up 1% or 2. And we had positive earnings from the banks, Wells Fargo, JP Morgan, Chase, all had good news, good earnings. And we jumped up, and we even got some decent news out of retail sales. Retail sales were better than expected. But remember, good news is bad news right now, and bad news is good news. We've talked about this. This retail sales number was stronger than expected. Typically, that's really good for a stock market. Right now, people don't want that. They want to see these numbers softening. And so the Fed doesn't have to be as aggressive. And when we have inflation running hot still, and people are still out there spending more than expected, the Fed is going to keep pushing on the brakes. Hey, Darren, what are your thoughts on this week's numbers?
I'm actually not surprised. I've been saying for a long time now that inflation is more than what the numbers are showing. And it's finally being reflected. I think those numbers are catching up to what the average person is seeing at the gas station, at the grocery store, the decisions that they're having to make. So these numbers don't surprise me at all. I mean, we've been harping on this since the bottom the market bottom in 2020 when the stimulus package came out. We've been saying for over 2 years that this course of action was going to be very inflationary, and we've been proven right. I'm not trying to break my arm, pat myself on the back here, or pat you on the back either, but we've been right. This has been entirely inflationary. That was limited to assets for about 2 years. It's really just been in 2020, late 2021, early 2022 that we've been seeing that in consumer products and energy as well. So these numbers don't surprise me. The Fed has to do a very painful course of action to get this under control, because these numbers, I don't think they've peaked. I honestly don't think they've peaked yet.
Well, you definitely can't say they've peaked because the expectations were blown away. So yeah, we definitely haven't peaked here. So look, this is going to be the same thing. It's going to be the Fed going to be more hawkish. That means that interest rates go higher. It means that the dollar goes higher. It means that oil probably goes higher. So there's lots of effects that are driving the market's reaction here. As you can see, the Dow somehow squeaked out a positive week. That surprised me when I heard that and looked at the numbers. But again, 4 out of 5 down days, but yet the Dow can squeak out a gain. S&P couldn't, down 1.4%. But look, that's not a big down week. The Qs, however, got hammered, down 3%. And oil went up 16% last week. It basically gave half of it up. And gold. Gold isn't an asset I follow a ton, but I've been really surprised at the sell-off in gold. Now, remember, gold is supposed to be a hedge for inflation. When inflation goes higher, gold's supposed to be in demand. It is not in demand whatsoever. And I've got a trade this week that I'm going to be focusing on one of the gold miners because I think gold is really in some trouble here. Let's take a look here at the S&P. On Thursday, I said, look, that was a very big bullish engulfing candle. This is a reversal candle. And we said, hey, we have to be open to the idea that that might have been a substantial bottom. However, every candlestick needs a confirmation candle. And Joe Jensen, one of our traders, actually just did a video on this week, basically outlining engulfing candles and how they work, and you need the confirmation candle. And so I said in my video, I need to see a confirmation candle. If the confirmation candle is a green candle, then that was most likely a bottom, and we have to pare back our bearishness and possibly get even a little bullish here. However, I said if we don't get the green candle, we get a red candle, then that's likely just a one-day pop. Take a look at this candle. It's very clear what we got. Now look, as traders, we have to trade the market in front of us. So I love being bearish. I love bear markets. But if we got a green candle on Friday, I would have to at least challenge my premise of, hey, maybe I'm wrong. Maybe the market isn't going to go down anymore. Maybe that was a short-term bottom. So if you were bullish, let's say someone went bullish on Thursday, and you were really bullish because you think there's going to be a big bounce in the markets, you have to take a look at this new candle and say, ouch, you know what? That doesn't fit my premise. And now I'm hoping and praying that the market turns around because that candle is bad news for me. Now take a look at that. That's what you don't want to get into as a trader, hoping and praying that something changes in the data. You want to be with the data. So the data is saying that was most likely a one-day pop. Qs did the same thing, gapped up 1%, ended up closing down. And so we take a look at the VIX as well. And this is where, like I said, I really think we do need to get that last capitulation, that last holy crap moment where people freak out. And we get a spike in the VIX above this 32, 34 area. What's your call on the VIX, Darren?
I'm with you, Rob. For me, 34, and I think I said this last week, 34 has to be the basement before I'm even going to consider that we're at some sort of capitulation right there. And I'd honestly prefer to see it go up to 36 to 40 to really remove any sign of hope that this market is going to turn itself around. I think hope is what's driving the bulls in this. I think they have to have that beaten out of them before we can even say that we're anywhere near any type of tradable bottom. I mean, that sounds harsh, but that's exactly what the VIX is telling me along the chart.
Well, it's not harsh. That's literally how bottoms are made. That's just the recipe of how bottoms are made. Everyone gets so overly pessimistic that they say, you know what, I'm not even interested in owning stocks anymore. That's how bottoms are made. So that has to happen before we bottom out. It just has to happen. That's how they're made. So let's focus our eyes forward. Let's talk about this week. So last week we had that big bounce. Friday's candle basically says, hey, you know what? That's most likely a one-day shot. However, I do need to point out that we are extended. We are very, very negative and very pessimistic, and the sentiment is very negative. And for anyone who follows sentiment indicators, knows that when sentiment indicators get to extreme levels, you tend to get reversals. For example, when markets get super, super bullish and everyone's in a great mood, that's typically the top. When people get super, super bearish, that's typically the bottom. As Darren said, I don't think we're at the bottom yet, but I think we're getting close. We're getting close to this level where it's about the most bearish you could get. So during these periods, bounces can happen. Any little bit of news comes out, 2 to 3% bounces, easy, because again, we're so stretched to the downside and it's so pessimistic. I've been talking about this. This is the last time I'm going to be talking about this. We started talking about this in August, saying, hey, the worst 6 weeks of the year are about to come up, September 1st to October 15th. Are statistically the worst 6 weeks of the year. There's been the most market crashes. And so we said, be cautious, be bearish. This is where we want to be. And look, here we are. Now, it doesn't mean that weakness is going to end on October 15th. We do need to understand that if we take a look at the statistics, one of the big reasons that we became bearish in September was because of this. And if we know that this is when it ends, we have to start thinking about, okay, maybe we're closer to the end than the beginning. What do you think, Darren? I know these seasonality patterns, again, every year is different. It can mean a whole different things, but we are going into this midterm. When do you think this seasonality weakness period is going to end?
I honestly think it's not going to be till the midterm. So I think we've got another at least 3 weeks left before we see that. I mean, people really want to see what's the House going to look like? What's the Senate going to look like? Is it going to be gridlock? Are we going to have more spending? That's, I think, what people are looking at. And so while this is the end of the traditional weak seasonality period, I think this year that it extends at least to the election.
Well, I mean, Friday's candle definitely told us it's going to at least go to October 17th. We know that for a fact. Well, actually, we don't know that for a fact yet, but we'll see how it opens up on Monday. One last thing, earnings season has officially started. So again, check your earnings for any of the trades you're looking to make. You can trade earnings, just make sure that you're trading them with a strategy that controls the risk, because there could potentially be really big moves off of earnings. One of the things I'm looking for a market bottom is when stocks start to go up on bad news. Right now, stocks are going down. When they have bad news, they go down. I'm looking for when stocks have bad news and they actually go up. That's going to be a little signal to me that we're definitely getting closer to a bottom as well. Economic reports next week, not a whole lot. Empire State Manufacturing Index on Monday, Philly Fed on Thursday. Really nothing to even pay attention to. So this week, we're going to stay with our -3. We've been at a -3 for a while, and we are going to stay bearish until the market tells us to no longer be bearish. And what will that mean? It means that we are above a 20-day moving average, above a 50-day moving average, and the 20/50 slope is actually going higher. Until those things happen, we have to be more bearish than bullish. That's just how it works. A technical trader has to follow the technicals. And right now, the technicals are very bearish. We think this is going to be another week next week. We'll see what happens, but we could be fairly close to a bottom as well. Let's take a look at some sectors.
Yeah, a little bit of movement in the sectors as far as the rankings go. But you can see not a lot held up there this entire week. Healthcare and financials were up meagerly. I think it's about the best way to put it. 1% for healthcare, 0.5% for financials. Consumer took a huge hit, to the downside, -3.8% right there. And you've got tech was right behind it as well. Utilities and real estate. Those I think are really interest rate reactions. Those are two sectors that are very influenced by interest rates. With rising rates, it makes the coupons on the dividends on the utilities no longer attractive, and it makes the debt finance on real estate no longer attractive as well. Materials and energy, just kind of hung out with the crowd and went down a little bit as well. There's no real news on those. Oil, as you can see, oil was down 7%, but there wasn't a whole lot of outsized movement in either of those. So let's take a look at the individual sectors here. Now, last week was the first time in my memory that I went to a -3 on utilities, and I still have to beat a -3. You can see that everybody had the Thursday bounce. Utilities gave up that as well. So I mean, this is down for definitely down for the week. Over here, communication services still at a -3. I mean, I've been in a -3 for a long time here, but you can see we briefly on Friday gapped up to touch that 20-period moving average, but we gave it all away. I mean, couldn't do it. I mean, when that gap down on Thursday, I think that's our next target for communication services. We're right at the bottom of a very minuscule range right now. If you look at just considering that Thursday just would have pierced that range, we could go sideways here, but I think communication services, the downside is the better play here. Looking at real estate, -3 on real estate as well. Friday gave up even more of its gains. So I think we're down within 0.5% of the low that the gap down low that we hit on Thursday. This just continues to look weak, and it's something I would be aggressively looking for shorts in. Industrials, however, looking better than a lot of other stuff. Still a -2, but as we talked about, when everything looks bad, you just have to pick what's the less bad and give that a higher rate. I would still be negative on industrials, but just not as much to the downside as some other sectors are. So -2 on industrials. Healthcare, I'm actually at a -1. This one got upgraded from last week. Had a pretty, it was one of the only ones that was only one of 2 sectors that was up for the week. So this is looking pretty good. And normally I would rate this at a 0, but with the rest of the weakness we've seen, I want to see another candle. If we can stay between the 20 and the 50, I'll upgrade it to a 0. But right now, I think it's just mildly bearish as far as healthcare goes. Looking at financials here, this is another one, -2. It doesn't look as bad as some other ones. So we've got some support right there down at the just above the 30 level right there. So we'll see which way we go. And that's probably if support keeps holding up, then I think the time could lead this to be a -1 or even a 0. But still, financials are looking pretty weak right here. On to consumer, we're at a -3. I mean, look at the candle on Friday. Gave back almost all of the gains that it had on Thursday. So it's very near those lows right there. And in one day, -3.7% for an entire sector. I mean, that's a huge move for an entire sector in a single day. So there's definitely weakness right here. But we are at essentially long support going back to July right there. So we'll see if we break through. And if we do, I think you probably got another 10% down easily in consumer. Looking at tech, -3 in tech. Only gave back half of its gains on Friday right there, but you can see it's well below previous support right there. Just not a healthy looking candle. I mean, these are all looking pretty anemic right here, but there's a lot that are looking worse than others. Taking a look at materials. This is another one that doesn't look as bad. It's still at a -2, but there's some hope on the way right there. And we'll see which way it goes, but this one's looking better than some other ones. Then finally, our only positive sector is energy. We're at +1 on energy. Even with the move that we had in oil this week, we're still up there. I mean, we could be range bound right here, which would be fine. I mean, that's you would still have some movement to the upside that we could hit right there, but we'll see where they go. I think the cracking spread is going to depend a lot on which way energy goes. And if you don't know what a cracking spread is, it's when a producer takes in crude oil and then they fractionate it out, they crack it, what they can sell the fractionated components of: diesel, gasoline, benzene, all the petrochemicals that they can get out of crude oil. What they can profit on for that is the cracking spread. So with oil as high as it is, do they have the pricing power to continue to raise the cost of those of the fractionated components of it? So I think that's the story right here. So looking at all the sectors together, you can see we've had a little bit of movement. Consumer tech, utilities, real estate, and communication services, all about as bad as they can look. Materials, financials, and industrials, slightly better. It's still not looking bullish. Healthcare, seeing some signs out of this. Healthcare's been a pretty good sector for for most of the year. So that's honestly not surprising. Energy at a +1. Now, as Rob said, with everything as stretched out as it is, when you get to those extremes, that's when you can have those reversals. So just be very cognizant of your position sizes. All right, let's take a look at some trades right now. So last week in real estate, we were short Weyerhaeuser, and this didn't do. And Weyerhaeuser was actually up 1.19% for the week. So this is still some time on it right there, but it appears to be, just kind of basing right there, between the 29 and 30 levels. So we're going to see which way this goes and just let the trade play out right there. All right. So this week we're looking at Annaly Capital Management. Ticker for that is NLY, and you can see this had nice, essentially a bear rally. I'd want to see one more candle to the downside, lower low, lower high, then I would be comfortable saying that trigger. A couple of different ways that you can play this right here. You can just go out to October 28th, the last Friday of the month, and just do a 1650, 1750 bear call spread. If you want to hold this for a little longer, I mean, you can see how far this has come down, and it's probably got a little bit more to go. Go out to the November, long the 19 puts, and then short next Friday, 1650 puts, make that a diagonal put spread. That's going to be a little bit more aggressive right there. But either trade is looking pretty good. In communication services, last week we were short Roku, and this did really well for us. This was down 10.5%. So if you're in that trade, you're probably looking at some pretty decent profits right now. And we've got a little bit more time on this to go. This week, we're looking at kind of a bear rally sideways play in Fox Corporation. Symbol for that is FOXA. You see it came down, but it managed to, it's right at that 20-period moving average right now. It went up and it was only down 15 cents for the day on Friday. It had that kind of an extended upper shadow right there. So we'll see which way this goes. We're going to play this sideways to a little bit slightly bearish here. Best way to do that would be go out there, hit the November 4th. So give this over in a couple of weeks at 28.30, 32 put butterfly right there. And so we're expecting this to go down right at 30, which is the lower end of the range, which is fine. You've got a couple of dollars right there that you can go right there. Or the other way that you can play this, would just simply be a 32.30 bear call spread would probably be the other way to play it. Healthcare. Last week in healthcare, we were long DXCM, and you can see it. It was down 4% for the week, but it's held up there pretty good. I mean, I would still say this is a bullish pattern right there. If you want to give this, depending on which way the market goes, if you want to give this a little bit more time, and we went down there and hit support at 95, and we stayed above it, which is pretty good. So we're going to hold on to this one. Not performing the way we wanted to, but that's okay. That's why we trade in a basket. This week, we're looking at Gilead. So for that is GILD. And we're going to go out to the Novembers and do a diagonal call spread long the 64s, short this Friday, 67s. And it's just got some bullish action. It's held up very, very nicely for the entire week. And it's up near the top of its range. So that diagonal call spread right there, if it stays at 67 for a week, you have a pretty good payday. And you can reevaluate it next Friday and see what you want to do with it. But this is looking pretty good as far as healthcare goes.
Last week in the industrial sector, we were looking at 3M as a short, and you can see the first 3 days we didn't really get any downside action. Huge candle on Thursday, and the candle on Friday is definitely not what we'd like to see. Remember, we want to see a lot of this big green candle get erased. This thing is not looking all that great. We've still got some time on it. We could still make it, but for me on this one, I want to see a much bigger red candle on Friday. So it was up 5% for the week. This week we're looking at CSX, Railroad Company. And we were looking at a low base or a bear rally. Look, it's somewhere in here. There are a ton of great bear rallies here. We had big bear rallies on Thursday, and it's just inviting us to take new short positions. So we came up here, hit our head on resistance 28. I'm looking at this just between 26 and 28. So I'm going to go out 2 weeks. I'm going to say, hey, you know what? I'm going to go to the November 4th, 26-28 bear call spread. Basically, I needed to go down below its current range in the next 2 weeks to be profitable on the trade. In the financial sector, last week we had Aflac sideways, and Aflac pretty much did that. It was up 2%. So you can see here, we closed the week down here, we ended the week here. So sideways, it was a good call on this Aflac. Still 1 week left. We need this just to sit in this area, and it'll be a nice profitable butterfly. This week, JP Morgan. Now, this is one of the banks that announced earnings on Friday and it had a big jump, and then it gave it all back. There are plenty and plenty of these out there, and I love this because it came right up into this level of resistance. It tried to peak above it, and it just couldn't do it. Just couldn't do it. Now, look, I'm not calling for this to go all the way back down to 102 and go lower. All I'm saying is, I think this 112 is some really good resistance. I'm not asking this to do all that much. I'm just looking for 2 weeks out, looking at the 110, 112 bear call spread. And all I need is this thing to just not go above 112 and drift a little bit lower. And it's going to be a nice trade. I'm playing this so small. And that's a great thing about options, is that you can make the smallest, wimpiest trades you want. You can make the biggest trade you want. That's a great thing about options. I'm just looking at $2 here on JP Morgan thinking, hey, big bounce off the bottom of 102. That's an 8% rally in 2 days. I think it gives some of it back.
Consumer. Last week we were sideways with ADM, Archer Daniels Midland. And you can see when it's down 2.1%, but it stayed pretty much in the range that we expected it to. Had a little bit of a down day on Friday, so we'll wait and see if that gets back into that range. But all told, we've got a little bit of time on this. Happy to see it go. Right now, we're looking at General Mills, and this is just in an uptrend. This is some of the more bullish action we've seen, and you can see we've just got a series of higher lows right there, and we're headed up into some a nice area of support right there. So go long the November 75s and short next Friday's 80. Turn that into a diagonal call spread, and we'll see it there. So we're just expecting General Mills to move up about $3 in a week, which for a cereal company, that's a pretty decent move. But I think with the action in this stock, it's more than feasible right there. Last week we were short DocuSign, and you can see, this is another one where the shorts really paid off. This was down 8% for the week, so that trade's looking really good for us right there as well. And you can see, it tried to rally on Thursday, and just couldn't do it. Friday's candle looked absolutely ugly, so I'm happy to let this one run. Right now we're looking at AMD Technologies. It's in a nice low base right there. You can see it's got support at 55 and resistance at 60. So ways to play this, you can go out there and just do, straight bear call spreads. Go out 2 weeks to October 28th, do the 55, 57. If you want to give it a little bit more time, do the 53, 58. Either one of those look pretty good.
And we talked about this last week. I hope everyone notices that we are doing pretty much all spreads here. Volatility is very high right now, which means that long calls and long puts are going to be very expensive. And so one of the big problems is when there's a lot of big high volatility and you buy a long call or you buy a long put, it's priced in so much volatility that sometimes the volatility bleeds away and you don't make a profit. The stock actually went the direction you wanted, but it didn't move enough in the direction you wanted, and you lose money on your call and put because you paid so much for the volatility. By going with the vertical spread, you're basically eliminating or reducing that premium that you're having to pay quite a bit. So we really like just the straight vertical spreads here. Last week we had Alcoa on a short, and Alcoa was down 1.7% last week. And look, this thing to me looks like it wants to head all the way back down to 34. But we got to get through this little bit of support here at 38. This week, gold miners. This one missed earnings badly. This is Newmont Mining, missed earnings badly back here, had a big drop, and you can see has not been able to bounce from its drop. We took a short on this about a month ago. It was a nice little trade to the downside, and you can see we've just been basing here now at a new low. We're heading down to the bottom. We don't know when. Well, we don't even know if it's going to break this 40. But this is a really good bet on a stock that has been perennially weak to drop below 40. So to me, you can play it two ways. You can basically say, I think it's going to go break 40 somewhere in the next 2 weeks. And so you go out and you do a November 4th, 37.42 bear call spread. Now I put a 37 target on it. You could go with a 35 target if you want. I think that's reasonable. But I always like to be a little bit less than what I think it could ultimately maximum go down to. Or the other way you could do this is you could simply play it sideways with a diagonal put spread. So diagonal put spread, what we do is we're going to put this on, and 40 is going to be our price. So the best case scenario is that it closes on 40 on Friday. That would be the best case scenario. That would be the maximum gain off this diagonal put spread. If it does break below, then okay, you just don't make as much. You just don't make as much. So maybe down here at 38, you didn't make as much as you would at 40, but it's still a profit. As you can see, as long as it doesn't go up, and probably somewhere around 42 would be your break-even point. As long as it doesn't go up, you're going to get paid. And again, this is a 1 week trade. And then at the end of the week on Friday, you get to decide, do I want to sell those November 45s or do I want to hold them? If you want to hold them, great. You can do another diagonal next week, or you can just hold the long puts because Newmont Mining is really crashing. Last week in energy, we've been playing energy more sideways than bullish over the past couple of weeks, and it's really paid off well. I mean, pretty much all of our sideways plays have been profitable on the energy stocks. So here we are, Occidental Petroleum. We had a sideways trade on it. It was down a little bit last week, but it's still well within our profit range. Well within our profit range on Oxy. Still one more week on that trade, so we'll see what happens. This week, Chevron, and no surprise, sideways. Just looking at sideways. Now at Maverick, we do a lot of what we call targeted butterflies, which is like a bullish or a bearish butterfly. If you don't know what a butterfly is, let me draw a quick risk graph. It's basically saying we believe it's going to stay within 2 points. We believe, again, point A, point B, those are your break-evens, and we think it's going to stay in this area for our time frame. So here we are looking at Chevron and saying, hey, we think it's going to just stay in the range. So we're looking at a 170, 160, 150 butterfly. That's going to be the range. And you get to decide what is your time frame. This would be a 2 week trade out to October 28th. You could do a 1 week trade if you want. That's no problem. You get to choose the time frame and options. That's another great thing about options is you get a lot of choices of what you can do on your trades. So that wraps it up for our trades for the week. If you're a Maverick trader, jump into our forum, start talking with all the other Maverick traders. We always love when our traders share ideas and we get a lot of people working together, get that synergy. To wrap this up, it's really too bad for any of you who were looking for a market bottom and Thursday gave you hope. I'm very sorry about Friday. If you are short, you should be happy. Thursday was a little scary day for shorts. Friday pretty much said, hey, you know what? That's probably not a capitulation low, and we probably have more downside. However, we do need to talk about, we are very pessimistic right now. Not just we as Maverick and our traders at Maverick, the world, the pessimism is very high right now. Whenever pessimism is very high, you tend to get good bounces during those periods. So I want everybody to be ready for when the bounce is going to come. It is going to come. Stay short. make trades to where, again, these vertical spreads we're talking about, these are very well insulated from any kind of real big sharp rally. You can't lose any more than your max risk, so just let it go. At some point, we will bottom, and then we'll flip around. But until then, we got to stay short. This market is much more bearish than bullish. Everyone have a great weekend. Take care. Be safe. We'll see you later. Goodbye.
Good trading, everyone.